A big story right now is that US investors are pouring capital into the UK. Reportedly, over 15 billion invested in UK stocks this year alone. So why are American money managers and retail investors loving Britain again? And should you follow their lead? In this video, I'll explain what's driving these flows, the real opportunities, and the ways I would think about adding UK exposure to my portfolio if I felt I needed to. Let's dive straight in. Foreign investors, especially from the US and Japan, have stepped up their investing in the UK this year so far. These buyers have come from across a multitude of different sectors: financials, insurers, house builders, and even defensive utilities. Analysts say that this is due to attractive valuations, higher dividend yields found in the UK when compared to other geographical locations, and a feeling that London is less expensive than US markets right now. With big institutional buyers visible in recent deals, this has helped to push the FTSE higher and rebalance global flows into ex-US markets. So let's talk through 4 of the reasons why this is happening, and the first of these reasons, as I've mentioned, is down to value. It's commonly accepted that things like the S&P 500 trade with a fairly high PE ratio, whereas UK stocks trade at noticeably lower valuation multiples than their US peers. Added to this, the UK market is far heavier in banks, energy, and consumer staples, which tend to pay a higher dividend over time. So for income-orientated investors, this looks very attractive. Therefore, analysts and commentators are flagging that the UK's relative cheapness versus the US is drawing reallocations, especially for managers hunting yield in a low-rate world. Reason 2 is down to the sector composition of the UK stock market. The UK has heavyweight banks and insurers included in the FTSE 100. These are things like Lloyds, Barclays, Aviva, Legal & General, just to name a few, plus house builders and energy names. These sectors are sensitive to local growth and regulation, and some of them are trading at historic discounts. Big foreign purchases, including US institutional stakes, suggest buyers see durable cash flows and rebalancing upsides for some of these names. For example, large recent stakes and acquisitions in UK financials and insurers show the global confidence in those areas. Reason number 3 is because there's a broader rotation away from the US markets. Recent research shows that lots of investors are trimming their allocation towards the US. This is partly because the stocks have got fairly expensive, but also because of the macroeconomic risks. These are things like the trade policy that we know is going on in America at the moment and the potential impact of that on growth. Reuters and other outlets have shown large inflows into ex-US equity funds in recent months as investors hunt for cheaper growth abroad. The UK has simply been the beneficiary of that trend. And reason 4, believe it or not, is currency. A weaker pound can boost sterling unhedged returns for overseas investors when local stocks hold value in local terms. On the other hand, if the pound strengthens, foreign investors will still buy if there's a strong valuation case. In short, currency moves can amplify returns for foreign investors, and this makes the UK look like a far better buying opportunity. It's essentially the inverse of what we're seeing in our portfolios. As the US dollar gets weaker or the pound strengthens against the US dollar, even though US equities might be increasing in value, our portfolios might not increase because of that currency distribution. US investors are currently getting the complete opposite of that, which, as we all know, can be quite nice to see. So with all this in mind, should you buy UK stocks or should you increase your allocation towards the UK? Well, that should depend on 3 simple questions. Firstly, why do you want more UK exposure? Secondly, how much fits your risk profile? And thirdly, how do you get it? Through individual stocks or for index trackers? Here's how I would think about each. Option A is what I'll call the low effort approach. If you already own global ETFs like the VWRL, you've probably already got quite a nice exposure towards the UK, so you might not necessarily want to change that. However, if you do, you might consider a small tilt of between 2 and 5% towards the UK. And this could be achieved through investing in UK ETF trackers or high dividend yield trackers which are based within the UK. That way you're getting the best of both worlds. You're getting the growth opportunity, but also 3 to 4% dividend income. This will allow you to grab the valuation and income benefit without over-concentrating. Option B, as I see it, is a moderate effort, and this is to focus primarily on income. If you want to chase yield, you might consider increasing your allocation towards the FTSE 100 or the FTSE 250. This gives you exposure to banks, utilities, and insurers, which give you a healthy dividend yield. The key point here would be to hold in an ISA because you don't want to pay any capital gains tax on any of those dividends that you receive. You want to recycle them, put them back in, so that can continue to grow over time. And option C is the higher effort, higher risk approach, and this is to pick individual stocks within the UK which you see as being most beneficial. If you enjoy research, you might consider a small handful of these UK-based stocks. These could be in things like insurers, banks, house builders, and you can tailor that towards the valuation or the yield, whichever you want to be chasing. If it were me, I'd keep these positions fairly small to manage risk and reduce volatility. As with all my videos, it's important to make sure you do your own research and only make investing decisions that you are happy with. These are just things that I think about based on the news that's coming out at the moment. but you've got to be comfortable in whatever decision you make yourself. Nothing you ever see on this channel is investing advice. If you're sat there now thinking, I do want to increase my allocation towards the UK, what 3 things can you do? Well, the first thing would be to check your current exposure to the UK. You might find that through your ETFs that you hold and the individual stocks and shares, you're already overly weighted towards the UK anyway. That might mean there's no need to do anything. If you find that you're not, or you just want to increase that, the next thing will be to set yourself targets as to what weighting you want towards the UK. Do you want to increase it by 2, 3, 4, 5%, maybe 10% if you really want to? And the final thing you need to do would be to choose the vehicle you want to invest in. Would it be an ETF approach, maybe the FTSE 100, the FTSE 250, or a UK high yield dividend ETF, for example? Or maybe you want to select a small handful of 3 to 5 individual stocks and shares and invest in a pie on something like Trading 212. That way you can really easily manage your allocation because you can see your total value in a pie, and you can track your weighting towards each of those stocks that you're invested in, rebalancing really easily. If you don't yet use Trading 212 and you want to, there's a link down in the description below where if you sign up and invest just a few pounds, you'll get a free share valued worth up to £100. So that can be a nice way to get started. In short, US money, and global money for that matter, is flowing into the UK because the valuation, high yield, and the sector mix looks quite attractive right now. But that does not mean you should blindly follow in. This is, of course, one of the worst decisions that can be made when investing, just blindly following. This is a good opportunity to take stock, reflect on your portfolio, and add thoughtfully if you feel you need to. My approach is always to protect myself through diversification and the use of tax wrappers where available. And remember that investing is a marathon, not a sprint. While there will be a few people out there who make millions overnight, that does not tend to be the way that most investing journeys go. If you found this video useful or interesting, please do hit the like button and subscribe just down below me. It really helps the channel out. And if you've thought about increasing your allocation towards the UK recently, drop a comment down below to tell me exactly how you're planning on doing that. As you'll have seen in one of my most recent videos, I am slightly overweighted towards the UK, and that's because of things like the dividend that I can receive over time. As always though, thank you very much for watching, and I'll see you in the next one.